100 years ago, Henry Ford did something unprecedented. He doubled his workers' wages to the famous $5 day week. And this allowed for a new pool of buyers to be able to afford the Model T. And his sales skyrocketed. And the reason I bring this to you is we are going in the complete opposite direction. With all these productivity improvements, lean manufacturing, and the latest buzzword, AI integration, the question is, who is going to be the consumers at the end of the day? Who's going to buy the car? Who's going to buy the house? Who's going to go cut his hair? Before we get into the numbers, allow me to make a quick disclaimer. I do work in the motor industry, but the views expressed in this video and on this channel are that of my own and not that of my employer or any other company. During my time on university, we were drilled to think in a lean way to reduce waste, to improve productivity. And all this fell under the term lean manufacturing. And the definition is in the name. You manufacture in a lean way. And that includes us. We are a resource. We are considered an input in the process. And we sold the notion that it's good for everyone. It's to make the company more agile. It's going to make the product cheaper. I've never actually seen the price of a product go down, but yes, it does. The cost to produce does go down. Let's look at the banking sector, for example. Since 2017, Standard Bank reduced its branch footprint by 42%. Nedbank openly states that self-service banking is so efficient that it's 37.5% cheaper than branch processes. Time Bank or GoTime now has 12 million customers. And I don't know about you, but I've never actually seen a Time Bank or a GoTime branch. In 1 year, Standard Bank closed 91 branches, 1,200 jobs affected. I know you might say we're not seeing massive retrenchments, but consider this. The combined customer count of the big five banks increased from 48.9 million in 2020 to 64.1 million in 2025. Over that same period, there was only 4 more bank branches added. I know you might think that, yes, but they probably hired a lot of people to work remotely and work online. But since that time, only 14,000 more employees were hired in that same period between 2020 and 2025. 14,000 more for all those millions of new customers. Let's take a different sector. Let's use HR, let's use human resources. The very people whose job it is to hire people is getting fired. Human resources is losing its humans. The system taking over is called ATS, Applicant Tracking System. And what it is basically, it acts like a digital bouncer, a gatekeeper, where it scans your CV, looks for keywords or whatever the AI algorithm program was programmed to do, and within a couple of seconds, if it finds your CV is not a match, it throws it in the scrap bin without a human resource ever seeing your CV. A study was done abroad and they found that 87% of companies are using AI tools as part of the hiring process. And you might say that, yes, but we're still not seeing these massive retrenchments or job losses, and that's good. That's the good news. But I'm just thinking that companies might do it in a different way, because retrenchments and job losses, the government and the unions get involved, and that's bad PR. They might do it in a different way. They might use natural attrition and hiring freezes, whereby when someone resigns or retires, they don't hire someone to replace that person. The job disappears. It's not all doom and gloom. The World Economic Forum, they're very upbeat. They have a very positive outlook. They believe that, yes, AI and automation will replace 90 million jobs by 2030, but 170 million new jobs will emerge. And I really hope that's true. I prefer Henry Ford's method. Henry Ford wasn't running a charity, he was a ruthless businessman, but he decided to share profits. And I know his primary objective wasn't to create this new pool of buyers which increased his sales. But wouldn't profit sharing have a similar impact today on a bigger scale? Because when you earning more, when you pay workers more, they have more buying power, they can spend more, and that money gets circulated in the economy, so it allows more people to be able to earn that money. It gives them an opportunity to also participate in the economy. When you earn more, you now don't cut your hair once a month, it's now once a week. Your barber is earning more money. He can now spend that money, and that money gets filtered all the way down. Shareholders, by definition, is supposed to share profits. Surely they can afford to share. I'd like to see some of these gains from productivity improvements and lean manufacturing initiatives and AI integrations. I'd like to see some of those gains go to the employees. I'd like to see it find its way all the way down to the shop floor. We know Pareto's 80-20 principle. And is it really necessary for that rule to still apply today? Is it sustainable? Where 80% of the world's wealth is controlled by 20% of the people. The companies are getting leaner. The AI algorithms are getting smarter. And I'm just wondering, just asking the question, is there going to be a consumer left to buy the products from these companies?